Imagine trying to navigate a sprawling, completely unfamiliar city by staring exclusively at the pavement directly in front of your feet. You might avoid a few cracks, but you take blind turns without having any idea where you're actually going. That is exactly what happens when you try to trade by staring only at a 5-minute chart. If you want to efficiently reach your destination, you treat trading like Google Maps. First, you zoom all the way out to see the entire city and your overall route. Then, once you're in the right neighborhood, you zoom in to find your exact street and make your exact turns. In trading, this process of intentionally switching between zoom levels to make precise decisions is called multi-timeframe analysis. Today, we are going to build a complete top-down trading plan. You will learn how to align massive macro trends on your higher charts with pinpoint micro entries on your lower charts. Because once you understand the larger context of the market, you stop guessing at random price noise and start executing highly structured, probability-driven setups. This roadmap outlines our approach. Step 1 is choosing your country. You start from the top, opening a higher time frame like the weekly or daily chart to establish the boss direction. The macro chart dictates the market's overall momentum. This creates a rigid, binary rule for your trading plan. If the daily chart is in an uptrend, you only look for buy opportunities. If the daily chart is in a downtrend, you strictly look for sell setups. Think of the market like an ocean. The higher time frame represents the massive, powerful waves controlling the water. The lower time frames are just the small surface ripples moving back and forth on top of those waves. If you attempt to trade against those massive waves using only the ripples on the 5-minute chart, larger market forces will sweep in and trigger your stop loss. Here is a daily chart showing a clear downtrend. Step 2 is mapping the boundaries of our city. We identify key horizontal levels, marked by these red lines. These are critical zones where buyers and sellers fought, resulting in clear historical bounces. This diagram illustrates how price interacts with those boundaries. The market creates a strong break straight through the resistance zone, then dips back down to touch that same level. That dip is the retest phase, the perfect location to anticipate the next push higher. By pre-drawing these major zones on your daily chart, you define precisely where you are going to look for a trade. It takes the guesswork out of your setup and eliminates the urge to enter randomly in the middle of a chart. Now that we know where we are, step 3 is fine-tuning our trend analysis. We drop down to an intermediate time frame, like the 4-hour or 1-hour chart, to see if the smaller waves are aligning with our macro trend. This brings us to a major problem: time frame conflict. The 60-minute chart on the left looks chaotic, while the daily chart on the far right shows a clean upward trajectory. Rule 1 is simple: always trust the higher time frame. Rule 2 is to wait for alignment. You must let that 1-hour chart stop falling, turn around, and point in the exact same direction as the daily chart before taking action. If those timeframes are fighting each other, doing nothing is a valid strategy. Stepping away to keep your capital safe is the smartest trade. Waiting for this alignment protects you from a very specific trap. It ensures you don't mistake a temporary pullback on the big chart for a brand new trend on the small chart. This 5-minute chart shows what happens when everything lines up. Step 4 is dropping down to the street view, right at the bottom of the retracement structure at this blue sniper entry point. You execute your entry just as price resumes its initial upward trajectory. On this gold chart, we see the real purpose on the lower time frame. The tiny red box allows for an incredibly tight stop loss, drastically reducing risk. We contrast that against the massive profit potential below, represented by the long green box. You never use lower timeframes to decide what asset to trade. They are simply mathematical tools you deploy to secure a highly optimized risk-to-reward ratio. So let's review the complete top-down journey. You start by finding your country to establish the daily boss direction. Then you find your city by marking major zones of support and resistance. Finally, you navigate down to the street level for a tight sniper entry. If you remember one rule from this system, let it be this: the big chart decides the direction, the small chart decides the entry. Now it's time to put this into practice. Open up a demo account and pick a single asset. Map out the daily boss direction, locate your key zones, and sit on your hands until you see perfect alignment on the 15-minute chart. By executing this specific sequence, you stop reacting to random price fluctuations. you transition from guessing to operating a highly structured data system.